Hey guys, welcome back. Today we are entering into the another concept which is retirement from partnership, and this is one of the problems which has been asked in the previous year question paper, which is from June 2024, and this is one of the good problem to see when we are learning retirement. So I have taken this. So let's quickly jump into the problem. So retirement, after retirement, what we are going to do? Okay, after retirement, the share of goodwill has to be taken back by the existing retained partners, and then if there is any revaluation done, how it has been how it has been transferred, and what's the partner's capital, and how we are paying that, and balance sheet after retirement. So this is what we are going to do when it comes to retirement. Okay, let's quickly read the question. Okay, X, Y, Z are partners sharing profits in the ratio of, okay, X, Y, Z old, which is 3 is to 2 is to 1. The firm's balance sheet is on as follows. Creditors given, payables, general reserve, capital account, everything has been given. Okay, capital, let's quickly plug it here. Capital, this is for our reference only, not part of the answer. Okay, is to 3,80,000. Okay, then new PSR also would have been given here. So let's see when it comes. Okay, and the balance sheet details given. So Y retired on 1st April 2023. So Y retired on 1st April 2023, and it was agreed that he should pay all his dues in full. Okay, whatever he has been liable to we as a partnership firm, we are liable to Y. That entire balance has been paid on that retirement date itself. Okay, for this purpose, goodwill has to be calculated. So goodwill has to be calculated under super profit method. Number of years purchases 4 years. Okay, other information has been given. So average capital employed. What's the capital employed is given. And net trading profit for the 3 years. These are all for the goodwill information, and rate of interest expected from the capital having regard to the risk involved, which is 10%. Okay, all these are for to calculate the super profit method. Okay, fair remuneration has to be fair remuneration. Also, we have to reduce it from the average profit to find out the, okay, obviously this we are paying the remuneration that is not related to the goodwill part, right? So we have to remove it. So 1,20,000 has to be removed. Okay, then stock revaluation detail given, stock, furniture, doubtful debts, and then liability, everything has been given. And then land and building also, the revaluation detail, some of the revaluation detail has been given. Okay, 4 things are 1 minute. All these informations for revaluation, all these for goodwill. Then what are all the information? Okay, then due to revaluation, the value of assets and liability are not to be altered. So if it is not to be altered, we should not uh, we should not really do the revaluation. We have to just work it out and transfer it to the new partners. That's it. Okay, so we have to create the memorandum revaluation, not actual revaluation account. Okay, so we should not alter any revaluations related to assets and liabilities. That's what the given in the question. Okay, in order to meet Y's obligation, X and Z bring in additional capital of rupees 3,50,000 and 7,20,000 respectively. Okay, they have brought the capital, and the new profit sharing ratio is 5 to 3. 5 is to 3, right? So they have asked us to compute the value of goodwill and show its treatment, profit and loss on revaluation of assets, and its adjustment among the partners. Show the balance of partners capital account after Y's retirement. Prepare firm's balance sheet after retirement of Y. Okay, so we have to prepare we have to find out the goodwill and its treatment, and we have to find out the profit and loss of revaluation, and then partners capital and partners capital account we have to find out. So totally these are all the 5 steps I have created here. So gaining ratio we have to find out, and goodwill you have to find out under super profit method, and then memorandum revaluation you have to prepare, then partners capital, then balance sheet as on retirement date. Yes, now let's quickly start with the problem. What's the first step? First step is computation of sacrificing ratio. Sacrificing here mostly for retirement, that would be gaining. So anyways, the steps, the procedure to work out is similar. So old PSR as usual, new PSR will give us sacrificing or gaining ratio, right? Okay, X, Y, Z. What's the old PSR? 3/6, 2/6 and 1/6. New PSR 5/8, 3/8. Okay, let's do LCM. 8 into 3, which is 24, then 6 into 5 minus 30 divisible by 6 into 8, which is 48, right? So this would be 2/6, then 6 into 3, which is 18, minus 8 minus 18 divisible by 48. So this would come as 6 minus 6 divisible by 48, then this minus 10 divisible by 48. So multiply this with 8 into 8 gives us 16/48. So the gaining ratio is 6:10, right? So we found the gaining ratio. Step 2, we have to find out the goodwill. What's the formula for goodwill under super profit method? Which is goodwill is equal to super profit into number of years of purchase. Okay, what's the super profit here? Super profit directly not directly given, but we have a formula for super profit. Super profit is equal to average profit minus normal profit, right? Okay, how can we calculate the average profit? To calculate the average profit, they have given the net profit for 3 years. Okay, 6,30,000, 5,40,000, 5,40,000 plus 6,75,000 divisible by 3, which is rupees 6,15,000 is the average profit. Okay, average profit we found out, but there is a fair remuneration to the partners for their services. We have to provide that, we have to remove that. So this is the average profit. We have to remove the remuneration, which is rupees 1,20,000, right? Minus 1,20,000, which is 4,95,000 is the adjusted average profit. Okay, we found out the average profit, right? Then we have to calculate the normal profit. Normal profit formula is capital employed into number of years purchase. How long? Sorry, not number of years purchase. This is normal rate of return, market return. Okay, so how much we have infused the capital? Average capital employed is 26,10,000 is the average capital given by the question, given in the question. So what's the normal market rate is 10% risk involved, rate of interest expected from capital, which is 10%. So 10%, so much? 26 lakh. This would be obviously 2,61,000. Okay, so let's find out the super profit. Okay, 4,95,000 minus 2,61,000. So what the company has earned, what the actual market situation. So the company has, what's the company has performed beyond market situation is called the super profit, right? As per market, there is a 10% of return, but the company has earned 4,95,000, which is beyond 10,000. So 4,95,000 minus 2,61,000, which is rupees 2,34,000 is the super profit. So goodwill is equal to 2,34,000 into number of years of purchase. So super profit is 2,34,000. Number of years of purchase, which is 4 years of purchase, right? Into 4. How much? Rupees 9,36,000 is the goodwill. So we found out the goodwill. What's the share of retiring partner? 2 by 6. 2 by 6 is the share of retiring partner, which is rupees 3,12,000 worth of goodwill is for Y share of goodwill. Okay, then we have to split it as per gaining ratio. What's the gaining ratio? Gaining ratio is 6:10. Okay, 3,12,000 for this is for X, this is for Z. 3,12,000 into 6 by 16. 3,12,000 into 10 by 16, which is 1,17,000 is the X has to pay. 1,70,000 has to be paid by X. Then 1,95,000 has to be paid by Z for the goodwill. Okay, right? So we have found out the goodwill also. Then we can directly jump into the memorandum revaluation. Memorandum revaluation is very easy one. It also simplifies our balance sheet also. Anyways, the balance sheet would be easy, but in this revaluation and reversal method, that would be more easy. We can just copy paste the question balance sheet. That's it. Okay. So what are all the revaluation details given? Stock furniture 10% reduced. To stock, to furniture. What else? Provision 5% reduced to provision for doubtful debts at 5%. Then what else? Provision for liability of 18,000 to be created against. Okay, provision for liability increased, so it will reduce the revaluation balance. Which is rupees 18,000. Then what else? Value of land and building is appreciated by 2,35,000. 2,35,000. Then what else? The investment is to be taken at its market value. So what's the investment value? 4,10,000. In market value is 4,10,000. Book value is 3,75,000 minus 4,10,000, which is 35,000 is the investment appreciated. 35,000. Right? Any other revaluation details? That's it, right? So they have given the details of how we have to prepare, whether we memorandum or that's a line item. That's a line of information given. So what's the furniture and stock, right? Furniture and stock depreciated, which is 10%. Furniture 42,000 and stock 31,500. So some provision for bad and doubtful debts is 8,70,000 into 5%, which is 8,70,000 into 5%. There is existing goodwill, which is 30,000 minus 30,000, which is 13,500 is the provision for doubtful debts, right? Yes, provision for doubtful debts we have found out. So where's the balance is higher? So obviously asset side. So there is a revaluation profit which has to be transferred to partner's capital account. So how much is the revaluation profit? 2,35,000 plus 35,000 minus 31,500 minus 42,000 minus 13,500 minus 18,000. So 1,65,000 for X, Y, Z. 1,65,000, 1,65,000, 1,65,000. What's the old PSR? 3 by 6, 2 by 6, 1 by 6, right? See, 3 by 6, 2 by 6, 1 by 6. Yes. So let's quickly calculate this. 3 by 6, which is 1,65,000 into 3 by 6, which is 82,500. Then 55,000. Then 27,500. Right? This is the balancing figure. Okay, right? Then what we have to do? We have revalued, but we have to reverse exactly to the opposite sides. So just we can easily copy paste. Okay. Okay. That's it. Change it to buy, two, buy. Okay. Now we have reversed. Now after reversing, we have to transfer to the partner's capital in the new profit sharing ratio. Okay, new profit sharing ratio is XZ, which is 3:5, right? Sorry, 5:3. 1,65,000 into 5 by 8. 1,65,000 into 3 by 8, which is 1,03,125. 3 by 8, which is 61,875. That's it. Balancing figure. Right, guys? Yes. Now we can directly jump into the partner's capital account. X, Y, Z, X, Y, Y, Z. Okay. For the first item, we have to transfer all the profit balance of all the partners, right? 970, 740, 380. Okay, this is the balances of all the partners. Then what's the second item? Obviously reserve should comes next. Reserves at old PSR, which is 3:2:1. Okay, what's the reserve amount? Reserve amount is 5,10,000. See, 5,10,000. 5,10,000 into 3 by 6, which is 2,55,000. Then 5,10,000 into 2 by 6, which is 1,70,000. Then 5,10,000 into 2 by 6, which is 85,000. Yes, we have transferred. Next thing is obviously revaluation, memorandum revaluation. What's the memorandum revaluation balance? This has to be come here, right? So memorandum revaluation 82,500, 55,000, then 27,500. Then 2 memorandum revaluation, which is 1,03,125, then 61,875, right? So we have transferred all the balance of memorandum. Now after that, after memorandum, what we have to add is goodwill. Okay, buy. What's the entry for goodwill? So we'll prepare the entry here. Entry is also must. We have to give a entry. So who is gaining? X gaining, Z gaining. Who is sacrificing? Y sacrificing. How much? 1,17,000, 1,95,000. Totals 3,12,000, right? So to Y's capital, sorry, by X and Z's capital, how much? 1,12,000, 1,17,000, 1,95,000, 1,95,000, right? So to Y's capital, which is how much? It has to be reduced the value balance of X and then Z, right? Finished. Then what else we have to add? In the question they have said that they brought the capital of 3,50,000 and 7,20,000. Okay, by bank, which is 3,50,000, 7,20,000, right? 7,20,000, 3,50,000, 7,20,000. Yes, is that it? Yes, that's it. We can close the books, close the partners capital account. Okay, first we have to pay off the Y's balance to bank account. Immediately it has to be paid. Okay, 7,40,000 plus 1,70,000 plus 55,000 plus 117 plus 195, which is 12,77,000 we have paid to Y. What's the closing balance? 9,70,000 plus 2,08 plus minus 5,117. Okay, 14,03,735. Then 3,80,000 plus 85 plus 27,500 plus 7 lakh minus 6,1875 minus 195, which is 955,625. So I have closed the books. Yes, let's quickly prepare the balance sheet as on retirement date. Okay, whatever given in the question, we can directly plug it there. Cash in hand, cash at bank. Cash in hand 17,000. Cash at bank, how much? 2,48,000. Okay, 2,48,000 is the balance. How much we have loaded? 3,50,000 by X and then 7,20,000 by Z minus how much we have paid to Y, which is 12,77,000. So closing, we'll get the balance of 2,48,000 plus 2,48,000 plus 3,50,000 plus 7,20,000 minus 12 lakh, which is 41,000 is the remaining balance we have, right? Then we'll copy paste there because it's like we are every time when we have to see, we are scrolling down and seeing that. So yes, so what's the debtors? Debtors has same as in the balance sheet minus provision, which is 30. So 8,40,000 is the balance. Then bills receivable, which is 1,65,000. Then stock in trade, which is 3,15,000. Then investments, which is 3,75,000. Then furniture, which is 4,20,000. Then land and buildings, which is 7,80,000, right? Then what else? The obviously first thing is capital. X capital is 14,37,375. Z capital is 9,55,625. Then creditors 4,25,000. Then bills payable 1,35,000. Then general reserve 5,10,000. That's it, right? Yes, we can close the balance now. 1437 375 plus 955 625 plus 425 plus 135 plus 34,63,000. Okay, let's total this side, so this side also 17,000 plus 41,000 plus the thing is 29,53,000. Okay, there is a difference which is 34,63,000, which is okay. We have already transferred the reserves, right? So we don't need to add the reserves again. So this is in the partners account, partners capital accounts only, so it's already filled here, so we don't need to add back. So then the balance will be 29,53,000. That's it, balanced. Okay, I hope you guys have understood. The first thing when it comes to retirement is any partnership. Okay, so gaining ratio or profit sacrificing ratio we found out. Then goodwill has to be find it out by super profit method. So super profit into number of years of purchase. Super profit formula is average profit minus normal profit. Average profit is the last 3 years profit used by number of years. So we found that, and the remuneration which has to be paid but they have not paid, so we have deducted the remuneration, so we got the adjusted average profit. And then we have to find out the normal profit. Normal profit is based on capital employed and normal rate of return. So we found that 2,61,000 is the normal profit, but our company has earned but the partnership firm has earned 4,95,000. So the super profit is 2,34,000. So this is the goodwill amount. So this is the super profit. So multiplied by multiplier 4, which gives us 9,36,000. So 2/6 is the profit share, goodwill share of Y. So goodwill share of Y has been found, which is 3,12,000, and as per the gaining ratio, it has been split among X and Z, and X and Z has been paid the respective amounts to the Y's account. So then we have prepared the memorandum revaluation. So memorandum revaluation account we prepared and we reversed also in the balances. So net off will get the net off the revaluation has been adjusted, but adjusted for it would be it actually extracts the required revaluation amount for the old partner, but the new partner they doesn't want to revalue, so they in their new profit ratio they have actually reversed everything. Okay, so see the revaluation balance has been added. So this is not revaluation, this is reserve. So the first thing when it comes to partners capital is partners balance, partners capital has to be added, then reserves, then memorandum revaluation, then goodwill share, then whatever the balance they have brought into the business, that has to be given here. If the retired partner has been paid with the amount, or whether their balance has been converted to loan account, that has to be come here. So remaining partners capital has been given. So remaining partners capital has been filled with the reserves, so we haven't added the reserves here. So total it, and then cash at bank actually includes the 3,50,000 and 7,20,000 of new capital introduced by the partners, and then net off will we have to do the capital liability paid to the Y's. So we'll get the balance sheet balanced. That's it. Thank you.